going to take a few minutes of our precious time to remind people, maybe some who were here, exactly 4 years ago today, October 3rd, three of us were up here on this podium, Sallie, Barbara, and I, and with Meredith Whitney. Sheila was in Washington dealing with the problems. She was knee-deep in the problems, and I think I probably should use more graphic language than that. Congress, just a few days before, had refused to pass the TARP legislation. And it was up again on this particular morning. And about 5 minutes into our session, Patty Sellers came up to me and whispered, "They passed the legislation." So I interrupted at my first chance. I announced that they had indeed passed the TARP legislation that added the stimulus, and there was general applause in the audience. It was really a remarkable moment. Now, we're a long way from that. I'm going to ask each of you to think about a scale of 1 to 10, 1 being the worst, is about where we were 4 years ago. And where would you place us, and I'll start with you, Sheila, where would you place us on a 1 to 10 scale on our ability to avoid, 10 being the highest, ability to avoid the kind of crisis that we've gone through?
Well, I have to say I'd probably only give it a 3 or a 4, unfortunately. I think we have improved the financial sector. There's more capital, there's less leverage in the system. The liquidity is a bit more stable. But a lot of that's been done through a discretionary supervisory process. We really haven't changed the rules yet. And leverage in particular was an extremely, a very bad problem during the crisis. It was the key driver for risk taking. It was a key driver of why we had to do bailouts. And so the capital rules, though, are far from getting done. The risk, I think, that are posed out of the financial system are worse, frankly. I think the interest rate environment, at some point, the Fed is going to have to start exiting. And that worries me a lot. You remember subprime started in 2006 when the Fed then had very accommodative monetary policy and tried to bump up rates. And the rest, as they say, is history. So I think the interest rate environment, or the inability of our government to get its fiscal house in order to make any decisions, frankly, on our fiscal situation long term, I think is also potentially very destabilizing to the financial sector. Then, of course, near term, we have Europe, which just can't seem to solve its problems. So I can't give it a very high grade.
So just to pause there a minute, if you were able as a czar to solve one of those problems right now, which one would you attack?
I would slap an 8% leverage ratio on every major financial institution. I think listen, you're always going to have cycles. You're always going to have institutions taking risks they shouldn't. But if you can make sure there's an adequate cushion of capital to absorb those unexpected losses when they occur, you're going to have a much more stable system. And higher capital can also, by constraining leverage, you can also constrain speculation, which in turn can dampen the risk of asset bubbles forming.
Okay, moving on to Barbara, who certainly knows about leverage back there. We were 2 weeks, 4 years ago, we were 2 weeks away from Lehman having failed. Barbara was working for Lehman. Barclays had moved in to kind of do a rescue operation. Now, first of all, where would you put us on the scale of 1 to 10?
I think it's a slow grind. I probably would be, maybe not at 3, but 4 to 5. The world has so much leverage right now, and Sheila is absolutely correct. You've got very low rates. About 45% of the U.S. government's debt is due in the next 2 years. If you were running the U.S. government as a treasurer, you probably wouldn't be in that job very long as a corporation, because you can't have that type of debt. But sadly, we need to have it that low right now in order to take your way out. I know we have Mohammed Al-Arian speaking in a while, and he knows this better than anyone else. But the regulatory structure, I'm a little more optimistic in the sense that you need to have the guardrails. The regulatory structure is coming into place. The rulemaking is slow. Our industry, the banking industry, needs to have that type of structure to operate in. And it's guardrails, and then there is risk-taking within that and in different asset classes. But for me, I'd say we're about grinding. It just feels that we've been in this so long, it's just the new normal. And maybe because I'm 58 years old, for me it is the new normal, right? We've been in the crisis not 4 years, much longer than that. You could see the fractures begin to develop much earlier, and you could see it in the different sectors. And when I look at where we are right now, we all know that the seeds for the crisis 10 years from now, if we were to look back, are being planted right now, and they may not necessarily be where you think they are, right?
Right.
So investors have all gone out of the equity markets, and they've gone into the debt markets without any real understanding of duration. So somebody will wake up one day, and when rates do, as Sheila says, go back up, you have to have at some point go up and realize they lost 20% of their funds without any understanding of why on a math perspective. So I think you're grinding your way through. You're not, however, where you were, where you every single weekend you had exhausted regulators, right?
That's true. We're not doing that. We're not.
Yeah, every weekend,
That's
every
true.
Monday you woke up, it was something else, right? And in my case, right around the time it was Lehman, which was, you know, obviously catastrophic. And probably would have been dealt with differently today, right? And those lessons are learned.
Mm-hmm. Sallie, 1 to 10?
Well, I don't know that I've got a particularly different number from these ladies because we haven't really tested the additional regulation that's come in, and so we won't know till we know. I'll build on with some more micro comments, the macro comments that Sheila made, because I think she covered it very well. But we do have some significant vulnerabilities that are left. So the money fund industry. Many of you are probably invested in money funds. It's a $2.6 trillion industry that individual investors put their cash into. They believe it's cash because it's cash on the brokerage statement. They believe it to be risk-free. It's not. They invest in things like European banks. They are not risk-free. They believe it's risk-free because there is a stable net asset value that's reported to them, so they believe they'll get 100 cents back on the dollar. And there's no capital backing them. Individual investors, implicit guarantees, no capital backing. What can go wrong? What can go wrong? And so we have these areas of significant vulnerabilities. And we have other areas, and Dodd-Frank has covered a lot of ground with a lot of pages. But Dodd-Frank is fighting complexity of regulation with complexity of business. It will work in some cases. In other cases, it won't. And there's some macro areas in which we're running in exactly the wrong direction very quickly. One that I've spoken about is that we are paying senior banking executives more in stock. What does stock do? It encourages you to take risk. If you invest in a stock, you do it because you want the management team to take risk in order to make the stock go up. Well, banks are bundles of risk. They're operational risk, they're interest rate risk, they're market risk, their reputational risk. Mm-hmm. We can go on and on and on about their credit risk, their counterparty risk. So what should we do? Pay them more stock, encourage them to take more risk. Rather than, hold on a second, how about we compensate senior executives in something that discourages risk, if that's the direction we want to go to. And I don't know that there are many in this country who want to go in the direction of encouraging more risk.
So, and your thought about what we might do is compensate partially in what?
Well, I have lots of thoughts, but on this particular issue, I think there are a couple of things. If you are looking for a security, if you don't want to give cash, there is a security that discourages risk. That security is a fixed income bond. Because if you buy a bond, the most you get back at maturity, no matter how much risk an executive or group of executives take, you get back 100 cents on the dollar, right? And so therefore, people who own bonds are very focused on controlling risk. That actually sounds pretty good. Here's an idea. How about if we compensate those executives based on the capital structure of those companies? So isn't it interesting that we compensate only in equity when in fact the capital structure can be $1 of equity and 8, 10, 20, and during the height of the downturn, $40 of fixed income. But what is the executive focused on? Maximizing the value of this $1, not those others. How about if it's $20 of debt and $1 of equity? Why don't we compensate in that way? It has the benefit of, as the capital structure gets riskier, the senior executive teams become less risky. Here's another idea. We went into the downturn. I love, by the way, let the record reflect, I love middle-aged white men. My husband happens to be one. We went into the downturn with the industry white, middle-aged male. right? All the research shows that more diversity reduces risk. So we came out of the downturn, whiter, middle-ageder, if that's a word, and maler. Now, I'm not on diversity, very important point about it's the right thing to do. I'm just talking about the numbers. And if you were to add different backgrounds, different perspectives, not necessarily different genders, people say, well, but they won't, maybe they'll ask the dumb question, maybe they won't have the expertise. Fantastic. Right? Slow everything down.
I don't imagine you'll get much argument here on any of that.
But you know what? I've been in the business for a couple of years.
Right.
That start with a 2, and it's not 2, it's 20 plus. I've had lots of these conversations at places like this. I've never interrupted a group of men, walked in a room and said, what are y'all talking about? They said, the importance of diversity for driving business results. I've never interrupted that conversation before, so we actually need to take it out of this room and talk about it more broadly.
Okay, that's a goal we all have to do. Now, Barbara, I want to ask you, because you have these corporate clients.
Right.
Big corporations from the very top on down. I think GE might be one of them. You're talking to them. You're getting a kind of range of opinions about them, about what they should do with their businesses right now. Right. What do you find them thinking that might be holding back or skewing or whatever?
Well, the corporations, the very large corporations, are in very good shape from a capital perspective. They have substantial cash, about a little over $3 trillion, more than half of which is actually abroad, because the growth has been principally in foreign countries. They're interesting. You could see the change this year, right? February, March, in front of boards, corporations prepared to make what I'd call real capital investment, property, plant, equipment, not just M&A, actually structured build-out facilities, manufacturing facilities in the United States. And it isn't that people still want to do that. They want to, but they need to get a return on their investment. And so there's so much uncertainty right now, they pulled back. A little bit of a delay. Some of that's political. There has to be a resolution on the fiscal cliff. I mean, and it isn't as much a tax rate issue, because there will be a tax. You just have to be able to program what the tax is. Right. And where do you invest to go forward? So people are starting to put their feet back in. We've seen a little bit more just in September, thinking, positioning for strategic, to tack on acquisitions that make sense, where you buy something and you can put it through your distribution channel. But nothing that I would say would, on a risk perspective, takes them outside of their core business. And those are the big guys, or the guys are the barbell strategy of some of the smaller ones too. So it is, they're waiting. And there's real positive news too. I mean, in the sense of, if you look at the United States and global growth, the US right now is the best hope to actually pull the world out. We're it. And it's because we're big. We're about 22% of global GDP, because Europe can't do it. Europe has got so much debt. And Sheila will know this better than me, but Europe's banks actually never wrote down the assets. So they're sitting there with, and these aren't the UK banks, they did, as well as a very good regulatory structure, as well as the US. So they're sitting there holding debt of Spain, for example, at par. That's a problem. And so it is going to take
And they have
them
less
time.
capital to start with.
Yeah.
Right.
They have zero capital against
They have
it.
zero. So they were all
Yeah.
hoping they could grow their way out of this. And you're stalled. So you're in for grinding, series of coming out. And then when you have the rates so low in the U.S., the U.S. is the world's printing press of currency. So, what's ultimately going to happen here? If you take a step back, you can sort of see. But there's some unusual in terms of inflation ultimately, and how do you cheapen debt. But look at the positive. By nature, I'm an optimist. I'm 36 years in this business. I'd have to be. And I was at Lehman, and Lehman was equity, 60% equity at my level with a mandatory hold. We owned 35% of the firm, right? And it failed. So I would have been really happy if I'd had debt, because I would have got 30 cents back on the dollar. Just wanted to say that.
But see, the point is, the issue wasn't that Dick Fold didn't have enough stock.
Right?
No, and
No, Lehman wasn't actually. Right.
you know, you have to ask yourself, really, because they always talk about how long do you own stock and currency. You know, this was interesting. It's an interesting study on Lehman, but because it's not quite what everyone thinks. But when you go to the positives about the U.S. economy, energy, right? In about 10 years, probably energy independent on a BTU basis. What does that mean for a lot of the clients that I'm dealing with are moving facilities back to the U.S. for the low energy costs for manufacturing? That's going to be great for Ohio. It's the heartland, and into Pennsylvania. So some real positive things, but how do we get through what is really a debt hangover?
Now, we've probably got time here for just a couple of questions right out here.
Hello, this question is coming as a private citizen. Thank you. This is for Sheila. I have a hearing for what you said in an earlier session, that banks should increase their capital and that we've got a number of lobbyists still trying to influence efforts. However, I would ask you to comment on the following. As we went through both the crises and as we're working through the CFPB, I am personally stunned at the lack of understanding of how these businesses work by the regulators. I'm not talking about sophisticated tranches and CMOs. I'm talking about the basics. And the number of times that businesses are called to Washington to help Washington and the regulators understand. So I'm just interested in your comments on how we work our way out of that.
Well, I think regulators do need to listen to industry. I wouldn't question that at all. What I think the problem is when one, the industry is irresponsible in some of their advocacy. And I think, like with anything, you can't lump everybody in together. And there are people who come from industry who can have a positive role in terms of providing information. I think one of the ways to discipline that process is to do it in a public forum. For instance, at the FDIC, we would invite industry participants and others to come in, but we would do it in a webcasted roundtable, and we would ask them questions, and we would drill down into issues. So there wasn't anything behind the scenes, them trying to write rules for us. I don't like that, and that sometimes goes on. So I think there are ways to do it where you can get that input, which you need, but in a way that is a positive process, a process of integrity, and ensures independence of decision making. I would also agree with you that we need to have people who understand the business that they regulate. Again, they need to be independent in judgment, but they do need to understand the business. And so I think that should be a priority for all the regulatory agencies. But that said, you know, I think the onus is on industry to be responsible in how it advocates for issues. And a lot of it is not good. You know, they go to the Hill, they try to block appropriations, they try to get people to write nasty letters. I think, like anything, there's a good way and a bad way to do it. And hopefully there will see more people engaging in a constructive way from the perspective.
Excuse me, I'm sorry. Another question? Have I seen any hands up here? Okay. Well, just for our end here, what thought would you like to end with that you would like to send this audience home to educate everybody out there who could use some education about these issues? So I'll start with Sallie and come back this way. Sallie?
Well, I think the thought I would end with is that there is a lot the regulators can do. However, there's also a lot the boards can do. And you know, there are some very significant macro tools they can use, such as compensation, such as making sure that they spend the precious time they have focused on not just the businesses that are in trouble, but with financial services, it's the businesses that are returning very, very well, very strong returns, that typically are the ones that are the trouble next time. And so making sure that we're holding our boards accountable for really working to reduce the risk in ways that really only, you know, they as boards can do. They've got quite a few tools at their disposal that don't involve, by the way, going down every last rabbit hole in every last business. But compensation, I mentioned diversity, spending time on the great businesses. The board has a very important role here.
Yes, indeed.
I just have one word: transparency. And I would be careful when you speak about just banks, because it's a much broader structure than that. Think about the hedge funds. Think about what people are doing. Do you want transparency? The more transparency you have, sunshine, as your mother told you, always cleans everything up, and it does. So I think you need structure, rules, and regulation. You need a social utility, going back to Jenny yesterday talking about strategic beliefs. You know, what is the social utility of banking? Every crisis should give you an opportunity to restructure. It is the lifeblood of business, so how do you do that? And you have to have a strong regulatory structure.
Right. And I would just say, building on that last question, I think there are a lot of responsible industry representatives, financial services representatives in this room, and if you can help further a constructive debate with regulators, I have found some of the best suggestions have come from people who have been in the industry. Sallie's suggestion for, maybe we should require that bank holding companies pay a portion of the variable compensation and debt. I would certainly support something like that. John Reed, former CEO of Citigroup, one of his suggestions on the Volcker rule I thought was absolutely the most constructive is look at the compensation incentives to generate trading profits if you really want to tackle this problem of speculation among safety net institutions. So I do think industry, responsible voices in the industry can really play a key role if they constructively engage with the regulators, because the regulators do need help and support right now.
Well, I think if you add up what we, where these women came down on the 1 to 10, it's we have a rating of 4 1/3 going forward, and I just hope, because I think Barbara did go 4 to 5, and so I just hope that if we meet again here, say 2 years from now, that we will be up at least to 7.
Good luck.
I hope so.
Thank you very much.
Thank you.
Thank you.